Ramanathan, CIO at ING Investment Management India, now joins in. Ramanathan, you have had liquidity which has been fueling this rally in the equity markets, but there could be a few bumps on the way in terms of third quarter GDP numbers, which we're expecting to be at 6.5%. The budget is going to be a big catalyst, as will the monetary policy. How do you believe all of these events are likely to impact the rally that we've seen?
Yeah, the GDP number which is going to come on 24th is actually history because everybody expects the number to be in the range of 6.3, 6.4. In fact, if it comes worse than expected, actually the market could bounce more on the positive side because the probability of an interest rate cut increases that much. So I am not really worried about the GDP numbers being poor. Now, the second point about the budget, yes, budget could be partially negative because clearly the finance minister has to look at revenue raising measures. So there is a scope for increase in excise duty. There is already talk about increasing substantially the ad hoc tax on diesel vehicles. So that could be possibly a dampener. But if the finance minister does manage to show a fiscal deficit of maybe 4.5 to 4.6 as compared to possibly 5.3 or 5.4 actuals this year, that should be taken positively by the market. Obviously, the market will look at in depth how the subsidies are budgeted for and what the finance minister talks about in terms of increasing the petrol and diesel prices.
Right, Ramanathan, just looking back, taking the focus really back to the equity markets, would you say that what we've seen happen over the last 7 weeks is an instance really of the markets running up too fast, too soon?
It's always the case because as at December end, there was so much of pessimism and market was factoring only negative news, whether it is the last year's interest rate increases, the government inaction, the Eurozone issues, the poor growth around across the globe. Incrementally, last month we have seen a good amount of positive surprises, starting with some sort of resolution of the Eurozone crisis, interest rates clearly turning positive for the markets, government slowly coming into action, I mean, as reflected by the PMO press release on the coal availability a couple of days back. And looks like the elections are also behind us, so populism incrementally would not be a problem. Yes, the market has risen swiftly, but if you see the valuations, FI13 is still at 14 times. Historically, we have traded at 15 times, but that is during a regime of 8 to 9% GDP growth. So surely the market is expecting growth to move up to 8 to 9%. May not be in FI13, but possibly in FI14 and remaining stable after that. Current levels of market is neither cheap nor expensive. Market is slightly moving ahead of earnings growth, which is a bit of a worry because if you have even a small negative news, the profit booking will be pretty severe. But still there is momentum in the market and the FIs are underweight India. There is good amount of liquidity which will support buying on dips in the market.
Sure. So, Ramanathan, a lot of people say that, there is still a lot of cash sitting on the sidelines waiting to come into the equity market. So, any marginal correction that you see will mean a lot more money coming into the equity market. So, in that light, would you say we've entered some sort of a broad-based bull market?
I would agree with that statement. The only risk, key risk, as I see, is the Eurozone issue, which is totally event-driven. Still, there is no firm clarity on the March 20th refinancing of Greece. The latest news is that they will part release that much amount which is required for the refinancing, and post the April elections in Greece, they would release, or they would plan the release of the remaining money. Europe is going to continue to be a problem. It's not an issue which can be resolved in a couple of months' time or 6 months' time. It's going to take 4 to 5 years. So, but for that, I would say that the market has momentum. You could see some more re-rating, although the scope for significant re-rating from 14 times is pretty less.
Sure, but as we speak, Ramanathan, Brent crude has broken past $120 a barrel. How worrying would you say that is going to be to the, to the momentum that we are seeing in the equity markets at present?
Yeah. See, the cost of crude is a combination of the Brent prices or the Dubai crude prices as well as the rupee. So if you have significant FI flows which helps in appreciation of the rupee, to that extent the Brent increase would be cushioned. However, that surely is a worry which we need to keep in mind. Today I feel the crude price also factors in global issues like the issue in Iran rather than genuine fundamental demand increasing substantially and supply shortage. So we need to see how that risk pans out. But crude at 120, especially the Brent, is surely an issue which will be at the back of the mind when RBI cuts rates. So possibly the pace of rate cut could be lower than market expectations. But I feel a 50 to 100 basis points rate cut and a CRR cut is in the offing. If you see today's LAF number, it is a negative 1,60,000 crores. That's a huge amount. So the system is choked of liquidity and there is enough reason because of the IIP numbers, inflation numbers and the expected poor GDP numbers to have at least a 50 to 100 basis points rate cut. If market, I don't think so the market is pricing in more than 150 basis points rate cut, although I've seen some economists predicting a 250 basis point rate cut. Given crude is at close to 120, I feel we are shooting ahead of the curve if economists are predicting a 150 to 200 basis point rate cut.
Finally, Ramanathan, any sectors that catch your fancy?
As I said last time when I was there, we continue to be overweight the interest rate sensitive sectors. We still feel the valuation in mid-cap PSU banks is cheap. We are also marginally overweight metals. Valuations there are cheap, but we need to keep a continuous watch on the progress of resolution of Eurozone crisis. And we have also added names in the industrial sector. Again, interest rate sensitive, although we will be watchful about stock specific issues as well as expectations running ahead. So we need to be careful, especially at 14 times market.